You've seen the posts. Just invest $10 a day and retire rich. Sounds great, until you realize most people who follow that advice end up asset rich and cash poor. Big account balances, tiny paychecks. The problem isn't how they're investing, it's what they're investing in. Today, I'm going to fix that. I'll show you why millions of investors park everything in the S&P 500 and why that comfort zone might actually be costing you. Then we'll break down why simpler portfolios consistently beat complicated ones, the 5 rules I use to find the strongest ETFs, and how 3 specific funds combined can add an extra $700,000 to your portfolio while paying you over $15,000 a month in dividend income. Let's get into it. Why everyone defaults to the S&P 500. The S&P 500 is the most trusted investment on the planet. For most people, it's the first ETF they ever buy and the last. And honestly, that makes sense. It's simple, it's diversified, and history backs it up. Just own the market and win, right?
Not quite. Here's what's actually inside SPY, the ETF that tracks the S&P 500. On paper, you own 500-plus companies. Sounds diversified, but look closer. Nearly 38% of your money is sitting in just 10 stocks: NVIDIA, Apple, Microsoft, Amazon. In fact, over a third of the entire fund is concentrated in tech alone. That's not a buffet, that's a plate with one dish. And while SPY's growth has been solid, its income tells a different story. The dividend yield? About 1.1%. So if you had $1 million invested, you'd earn just $11,000 a year in cash. That's not financial freedom, that's financial patience. The S&P 500 is a wealth-building machine, but it doesn't pay you to live along the way. Why simplicity wins? The investing world is obsessed with complexity. New ETFs launch every week. Experts constantly pitch the next big strategy. But here's the truth. Complexity doesn't create better results. It creates chaos. Most investors buy too many ETFs, overlap their holdings without realizing it, trade too often, and end up with a portfolio that looks busy but performs average. The real edge? Simplicity, when it's structured the right way. You don't need 15 ETFs chasing every corner of the market. You need 3 forces working together: income, stability, and growth. That's the entire system. Clarity over confusion, consistency over chaos. The 5 filters I use to pick strong ETFs. Before we get to the specific funds, here are the 5 rules that guide every pick. 1. It has to pay you. A solid dividend yield means you're investing in companies that actually generate real profit. 2. That income has to grow. Getting paid is nice. Getting a raise every year is how you build freedom. 3. It needs steady price appreciation. That's the engine that powers compounding over time. 4. It has to be efficient. Low fees, low turnover, no unnecessary drama. 5. True diversification. Not hundreds of companies all moving in the same direction, but different sectors, geographies, and business cycles balancing each other out.
When all 5 come together, yield, growth, appreciation, efficiency, and diversification, you get a system that compounds in a way no single fund can match. ETF number 1, SCHD, the foundation. Every great structure needs a foundation. In this system, that's SCHD, the Schwab U.S. Dividend Equity ETF. SCHD is built around one idea: own America's strongest companies with a proven track record of paying and growing dividends. We're not talking speculative bets. We're talking businesses like AbbVie, Lockheed Martin, PepsiCo, Merck, and Chevron, names that have carried portfolios through recessions, rate hikes, and everything in between. The sector mix keeps things steady. About 19% in consumer staples, 18% in energy, 16% in healthcare, 10% in industrials, and roughly 10% in tech. That balance means you're not overexposed to any one area. Now the numbers. SCHD currently yields around 3.9%, nearly 4 times the S&P 500's 1.1%. But the real strength is the growth of that income. Over the past decade, SCHD's dividend has grown at a 10.43% annual rate. That means your cash flow is outpacing inflation every single year. You're effectively giving yourself a raise without doing anything. On the risk side, SCHD stays disciplined. Annualized volatility near 16%. Steady. Predictable. No wild swings. This is the workhorse of the portfolio. It anchors everything with real income and reliable growth. ETF number 2, INTF, the global stabilizer. Income is covered. Now we need balance, and that's where INTF comes in, the iShares International Equity Factor ETF. While SCHD keeps things close to home, INTF takes your money global, spreading across nearly 500 companies from Europe, Asia, and Canada. Names like Novartis, Nestle, ASML, and SAP. World-class businesses that don't need the U.S. economy to thrive. So when American markets cool off, your portfolio doesn't have to follow. Sector-wise, INTF is built for durability, 25% in financials, 19% in industrials, with solid coverage across healthcare, consumer cyclicals, and technology.
When high-growth tech stumbles, banks and industrial giants often pick up the slack. What makes INTF special is its factor-based approach. It doesn't just mirror an index. It selects companies based on strong balance sheets, stable earnings, and solid valuations. It filters out the noise. The dividend yield sits at 2.78%, modest on the surface, but that income has grown at a remarkable 19.36% annually over the past decade. Volatility clocks in around 16.8%, making it one of the most stable options in its category. And no single holding exceeds about 2.5% of the fund, balanced by design. ETF number 3, QQQ, the growth engine. Every portfolio needs acceleration. That's QQQ, the Invesco QQQ Trust, tracking the NASDAQ 100. Inside, you'll find the companies reshaping the modern world: NVIDIA, Microsoft, Apple, Amazon, Meta, Tesla, Alphabet, Netflix. Over half the fund is in technology, with the rest spread across communications, consumer sectors, and healthcare. QQQ isn't built for comfort, it's built for growth. The dividend yield is just 0.48% because these companies reinvest their profits back into expansion and innovation. Volatility sits around 23.5%, making it the most dynamic of the three. But that dynamic nature is exactly the point. SCHD gives you income, INTF gives you balance, QQQ gives you velocity. And when all three work together, they cover each other's gaps like a well-coordinated team. Why these three work so well together? Here's what most people miss when building portfolios. Adding more funds doesn't mean more diversification. What matters is whether your funds actually behave differently. These three do. SCHD and QQQ share only about 5% overlap, a handful of names like Cisco, PepsiCo, and Texas Instruments. Beyond that, they move in completely different directions. SCHD versus INTF, the overlap is essentially zero. INTF holds international companies you simply won't find in a U.S. dividend fund.
QQQ and INTF? Also no meaningful overlap. One captures American innovation, the other captures global strength. They move differently, and that's the entire point. Put it all together, and you have 3 ETFs covering different regions, different sectors, and different business cycles, with only 5% total overlap. When one market slows down, another tends to pick up the slack. That's a structure built to absorb volatility while still compounding wealth steadily. The portfolio breakdown. Here's how the allocations work. 40% SCHD, your income engine, steady cash flow from proven U.S. dividend payers. 40% INTF, your global layer, diversification across Europe, Asia, and Canada. 20% QQQ, your growth driver, exposure to the world's leading tech and innovation companies. When you blend those three together, the combined portfolio averages 2.77% dividend yield, 13.81% annual dividend growth rate, 8.54% annual price appreciation. That's income, growth, and acceleration working in sync. The 30-year projection. Let's run the numbers. Josh starts simple, just $10 a day. No lump sum, no special timing, just consistency. Year 10, portfolio grows to around $65,000. Annual dividends hit roughly $2,000. Year 20, balance climbs to approximately $324,000. Dividends reach nearly $20,000 a year. The snowball is rolling. Year 30, portfolio value hits $1.84 million. Annual dividend income, about $187,000. That's over $15,000 a month just from dividends. How does it compare to the S&P 500? Same $10 a day, same consistency, very different outcome. By year 10, SPY pays about $300 a year in dividends. The 3 ETF portfolio pays $2,000, 6 times more. By year 20, SPY's dividends reach roughly $800. The 3 ETF portfolio is paying $20,000, more than 20 times greater. By year 30, SPY generates about $1,300 a year in income. The 3 ETF portfolio delivers $187,000, a difference of $185,700 every single year. And the total wealth gap? By year 30, this portfolio reaches about $1.84 million compared to SPY's $1.1 million. That's nearly $740,000 more, not from taking higher risks, but from building a smarter structure from day one. 3 ETFs, one clear system, and the $740,000 head start over the most popular investment on Earth. If you want to take it further and learn how to earn over $8,000 in monthly dividend income using 5 compounding strategies, click the video on screen right now. See you there.